Hello everyone and welcome back to my channel. Are you struggling with consistency? This exercise will transform you into a professional trader. In this video, we'll look at how to do the exercise from Mark Douglas's must-read book Trading in the Zone. Mark was a pioneer in trading psychology, and his work has helped traders worldwide master the mental side of trading. All credit for the concept discussed in this video goes to Mark and his incredible contributions to the trading community. If you haven't read this book yet, I highly recommend adding it to your trading library. The exercise. Learning to trade on edge like a casino. What is the objective of the exercise? Exercise objective is to convince yourself that trading is a simple game of probabilities, like pulling the handle of a slot machine. Understand that individual trade outcomes are independent and random, but over a series of trades, they produce a consistent result. By doing the exercise, you will learn how to think like a casino. Number 1. Have an edge. Ensure the odds of success are genuinely in your favor. Number 2. Think in probabilities. Apply the 5 fundamental truths to your trading mindset. Number 3. Execute consistently. Do everything you need to do over a series of trades to maintain your edge. How to do the exercise. Step 1. Pick a market. Choose an actively traded stock or futures contract. Ensure it's liquid and fits your margin requirements. Make sure that you can trade at least 3 future contracts per trade. Step 2. Define your edge. Choose a set of market variables that define an edge. This can be any trading system you prefer as long as it meets the following specifications. Specifications will be covered on the next slides. Specifications. Trade entry. The variables you use to define your edge have to be absolutely precise. The system has to be designed so that it does not require you to make any subjective decisions or judgments about whether your edge is present. If the market is aligned in a way that conforms with the rigid variables of your system, then you have a trade. If not, then you don't have a trade, period. No other extraneous or random factors can enter into the equation. Stop loss, exit. The same condition applies to getting out of a trade that's not working. Your methodology has to tell you exactly how much you need to risk to find out if the trade is going to work. In any case, whatever system you choose, it has to be absolutely exact, requiring no subjective decision making. Again, no extraneous or random variables can enter into the equation. Time frame. Your trading methodology can be in any time frame that suits you, but all your entry and exit signals have to be based in the same time frame for this exercise. However, trading in one time frame does not preclude you from using other time frames as filters. For example, you could have as a filter a rule that states you're only going to take trades that are in the direction of the major trend. In fact, the lowest risk trade with the highest probability of success occurs when you're buying dips support in an uptrending market or selling rallies resistance in a downtrending market. Taking profits. Key principles. Pay yourself. Take profits as the market makes money available to you. Create winning experiences. Build a belief in consistency by scaling out to winning trades. How to take profits. Divide your position. Split into thirds or quarters and scale out as the market moves in your favor. Risk-free opportunity. Lock in profits to experience a carefree, relaxed state of mind. Final exit. Look for significant highs, lows, longer time frames and place orders just below, above these levels. Why it matters. You'll experience what it feels like to trade with no risk and a winning mindset. This reinforces the belief that you are a consistent winner. Trading in sample sizes. The typical trader practically lives or dies emotionally on the results of the most recent trade. If it was a winner, he'll gladly go to the next trade. If it wasn't, he'll start questioning the viability of his edge. To find out what variables work, how well they work, and what doesn't work, we need a systematic approach, one that doesn't take any random variables into consideration. This means that we have to expand our definition of success or failure from the limited trade-by-trade perspective of the typical trader to a sample size of 20 trades or more. Testing your edge. Once you decide on a set of variables that conform to these specifications, you need to test them to see how well they work. In any case, keep in mind that the object of the exercise is to use trading as a vehicle to learn how to think objectively, in the market's perspective, as if you were a casino operator. Right now, the bottom line performance of your system isn't very important, but it is important that you have a good idea of what you can expect in the way of a win-to-loss ratio, the number of winning trades relative to the number of losing trades for your sample size. Accepting the risk. A requirement of this exercise is that you know in advance exactly what your risk is on each trade in your 20 trade sample size. It needs to be the same for all 20 trades. Doing the exercise. When you have a set of variables that conforms to the specifications described, you know exactly what each trade is going to cost to find out if it's going to work. You have a plan for taking profits and you know what you can expect as a win-loss ratio for your sample size, then you are ready to begin the exercise. The rules are simple. Trade your system exactly as you have designed it. This means you have to commit yourself to trading at least the next 20 occurrences of your edge. Not just the next trade or the next couple of trades, but all 20, no matter what. You cannot deviate, use, or be influenced by any other extraneous factors, or change the variables that define your edge until you have completed a full sample size. By setting up the exercise with rigid variables that define your edge, relatively fixed odds, and a commitment to take every trade in your sample size, you have created a trading regime that duplicates how a casino operates. If you believe in the 5 fundamental truths and you believe that trading is just a probability game, not much different from pulling the handle of a slot machine, then you will find that this exercise will be effortless. Effortless because your desire to follow through with your commitment to take every trade in your sample size and your belief in the probabilistic nature of trading will be in complete harmony. As a result, there will be no fear, resistance, or distracting thoughts. What could stop you from doing exactly what you need to do, when you need to do it, without reservation or hesitation? Nothing. Follow the rules of your trading regime as best you can. Doing exactly what your rules call for while focused on the 5 fundamental truths will eventually resolve all your conflicts about the true nature of trading. You will know for sure that thinking in probabilities is a functioning part of your identity when you will be able to go through the one sample size of at least 20 or more trades without any difficulty, resistance, or conflicting thoughts distracting you from doing exactly what your mechanical system calls for. Then and only then will you be ready to move into the more advanced subjective or intuitive stages of trading. Thank you for watching.